Good day and welcome to the Kerner Perspective Offshore Portfolio Commentary for the half year to 30th of June 24. But as we've done in all the videos in the series, the previous three, and we'll do in the Flex Fund commentary, we've really gone beyond to July and in some cases even discussing some of the very recent developments as they were in August. Looking at sort of a pie chart of average holdings, which is obviously a blend of strategies and vintages of portfolios, but I think the key message there, quite big holdings in the likes of JP Morgan, HSBC, Royal Dutch Shell, Micron's quite significant, as well as the likes of BNP Paribas, with quite a few smaller holdings, sprinkled in between. We're going to go through these slides quite quickly, mainly because we've covered quite a lot of these shares in the past videos, and really it's focused more on bringing you up to date with some of the more recent developments. It's also important to say that although we're showing 10-year graphs here, very few of the portfolios would have anything like that sort of history. So we really, from a comparative point of view, need to look more recently, probably last 3, 4, 5 years. And obviously even more so in some of the holdings that are relatively new additions to the portfolio. All right, starting out with our biggest holding, which is HSBC. You can see there, like a lot of UK listeds, very disappointing performance. I think the interesting thing for us is the share price roughly where it was a decade ago, and obviously massively up from 2020 with the COVID pandemic impact, but really going nowhere in a hurry, which is a little bit strange for us because we think it's a quality business with a great emerging market footprint, great balance sheet. It really is a giant in anybody's books. But the thing that puzzles us is if you look at their history of delivery, of course, again, looking to almost right off the 2020 period because of the noise from COVID. But you can see there the trend is fairly solid. Of course, the last 3 years are forecast, but we've already got quite a lot of visibility on the 2024 earnings, which is forecast to come in a little under $1.30. So with dollar pound at 1.3, give or take, gives you almost a pound's worth of earnings. So on a share price of a little under 7 is putting it on a very undemanding 7 rating. And as you can see there, the dividend yield, if I normalize it, so in other words, don't look at that, what's expected to be a sort of a bumper 2024 dividend, you're looking at a normalized dividend yield of over 7%. So in our assessment, if those forecasts are even halfway correct, you're buying a really good franchise on a very, very low rating, and you're getting a dividend yield that is really very, very compelling. So we remain comfortable with HSBC, although we do recognize, of course, there's been some changes in senior management. Right, then moving on to Micron, and we must say in this half year or so, we have sold quite a few Micron shares across client portfolios. In part, it was just because the valuation didn't make a lot of sense relative to the fundamentals. You can see that share price really just, behaving like an AI stock. And although there is a little bit of AI pickup, and obviously they were or are going to be a recipient of fairly significant US government grants, I think of the order of about $6 billion. It just felt as though the rally was really ahead of the fundamentals. And I think this chart here shows that, if you look Q on Q versus and year on year, obviously the comparative period is a fairly low one, if you look particularly on a year on year, because of the impact of the trade restrictions between China and the US in terms of technology. But there you can see, both on the quarter on quarter and year on year looking good, but again, maybe slightly flattering because of the disruption of the sales to China. And I think that's quite well reflected in here. So if you look 2024, 2025, earnings really very, very dull. And that really just reinforces the view that we think it is very much ahead of the fundamentals. If you think market's fairly confident they're going to give you, $8 or $9 worth of earnings in 2026. That's firstly, it's quite a long way out, and secondly, it still only puts them on about an 11, 12 multiple. So, we have some concerns about the valuation, and that was the reason for essentially trimming the holdings, which is lovely because essentially our clients sit with a free position, and in fact, many would have made money and are still sitting with a free position. All right, then the Treasury bond, which was really just our bet on trying to lock in some yield as opposed to just being fully exposed to the money market that's going to decline, we believe, quite quickly and quite significantly over the next year or 18 months. So really just trying to lock in a little bit of yield. Of course, the bond ETF has a duration of not equal to the 10-year, but it's giving you a nice running yield, and we do believe there's a fighting chance of actually getting a little bit of capital pickup on these as well. Then we've got a very significant holding in Shell. We did trim Shell for quite a few clients in the half year. The share prices run very, very hard. Obviously, initially 2020 hurt them. Then we got the supply disruptions, but more recently, of course, 2022 was the Russia invasion of Ukraine, which really ignited energy markets, both oil and natural gas particularly, and Shell was a beneficiary of that. And as you can see, share price pretty much in record territory, in spite of the fact that some of the commodity prices have actually eased back a bit. If you look at the earnings per share and the dividends per share, it looks very, very good, on track. But I think there is a caveat to this, and that is that firstly, that 2022 earnings tended to, slope that trend line up. And if you have to be honest, the earnings were actually more. If you look from 2014 to 2021, was sort of, around $2 or thereabouts. So yeah, you do get the feeling that this purple patch that they enjoyed in 2022, that trend is actually not going to necessarily continue as is forecast there. Obviously, going a little further out, 2025, 2026, the market's looking at a slight decline in earnings, but dividends will probably maintain. But we're not quite as optimistic as that, and that was one of the reasons why we trimmed those positions. As you can see here, energy markets have definitely reset lower. So you've kind of got a situation where both Brent crude and natural gas, as illustrated on this chart or on this slide, have reset at much lower levels, and yet the share price and the outlook for earnings is very optimistic. So that's the reason we trim back the holdings a little bit, in spite of the fact that, of course, Shell is a very big player in natural gas. It's not only a crude or petrol diesel play. Right, then on to JP Morgan. I think generally the US banks have outperformed, in large part helped by the outperformance of the US economy. As you can see, at $210, $212 a share, JP Morgan pretty much in record territory. If you look at the earnings, probably supports that view. If you look at the forecast for 2024, around $18 worth of earnings. Looks good, but you can see that 2024 forecast is a little outside of trend. So arguably maybe a little bit too much good news baked in. So in our assessment, relative, say, to the likes of BNP Paribas or HSBC, JP Morgan looks a little dear. Obviously also somewhat more of a beneficiary of investment markets in the US particularly, and the US economy, which seems to be coming slightly off the boil. So on balance of arguments, we would feel that JP Morgan is probably a little ahead of the fundamentals, and in a couple of client portfolios, we did trim overweight positions there in the half as well. This is BNP Paribas. Just to remind, the big investment hypothesis there is, European banking tends to be a little bit more predictable than most geographies. But it really was the bet, when we bought it around mid £40, 40 euros, sorry, was really just a case of the discount to net asset value or book value was excessive. And you can see over a decade hasn't done very much, but from when we bought it, probably 3, 4 years ago, it's been very, very kind, and of course, generous dividends as well. Then Volkswagen, to be honest, is one of the disappointments. We ironically like the China exposure, but clearly, with almost half of all new vehicle sales in China being electric, and Volkswagen being behind the curve, and obviously, the Chinese buyers definitely favoring the Chinese brands, particularly the likes of BYD. Volkswagen has got a lot of work to do. Having said that, looks very cheap on fundamentals, and the company is definitely focusing not just on top line and sales, but definitely more on profitability, which we think will sustain them. But we do believe that in spite of some good news for the traditional internal combustion engine type of producers, where you've seen some swing back to ICE or hybrid cars, I think the likes of Volkswagen really have to get their act together quite quickly to pivot into new powertrains. But we're very comfortable with the valuation, and sense that the market's being overly negative on their outlook. GSK, it just seems to sort of vacillate between £12 and sort of £18. It's come off a little bit of late. We remain positive. We feel the valuation is undemanding. We're quite confident in the new strategy. Obviously, now that GSK is more of a pharma company and Haleon is more the consumer and OTC company assets. We like the GSK story. We believe that Emma Walmsley, laid out the right strategy, and we believe that this company will deliver solid earnings growth. But as we've seen in the case of Aspen and others around the world, global pharma really hasn't been rewarded for delivering results. But we're comfortable with the hypothesis and also comfortable with the dividend outlook. Then Microsoft, also a fairly significant holding, along with the Magnificent Seven, really ran very, very hard from when we bought it, just under, around $200. It had a massive run. We did trim for a couple of clients. You get the feeling that gravity is starting to take over. You had a multiple of well over 40 times, and although it's a good business, as we'll see in a second, the reality is the earnings growth is not strong enough to unwind that PE. Just a reminder of where they operate in terms of the productivity and business solutions in intelligent cloud, personal computing, generally doing well with the exception of devices. Very much an annuity business model. And as you can see here, very, very strong cash flow. Investment is falling off a cliff in spite of obviously investment in cloud and data centers. But generally, all the financial metrics look very good. The only problem is that if you look at this, which is the point, that it tracks the trend, earnings trend beautifully. But you can see that earnings growth is fairly flat relative to what you would actually expect of a company currently trading on a 35 or a 36 multiple. So we did trim for a couple of clients. We still like the story, but feel that the valuation was overcooked, and it's probably one of those that may have a slightly choppy rest of 2024. Diageo obviously got marked down quite heavily from well over £30 to mid-20s, with a slowdown in Latin America, in the Caribbean. We still think it's a great business model. Premium brands is really the way to go if you're going to be in the alcohol or in the brewing business. We like the story. For a long time, truthfully, the valuation was overcooked, but we're very comfortable with the outlook and see this more recent weakness as an opportunity. And we did, over the last 6 months or year, we did add or acquire new positions where none were held. and will continue to do so. Then here's the Treasury bond ETF. You can see taking advantage of that price weakness as yields moved higher. And it's a bet on trying to lock in a bit of yield, and B, in the hope that we're actually able to squeeze out a little bit of capital gain, as we discussed before. Then BMW, ironically, we thought Volkswagen was better placed a couple of years ago, but BMW is definitely trading better. Share price has come off, but I think it's probably more a function of what has been happening with the Chinese EV producers rather than any specific problems with BMW themselves. All right, then the iShares MSCI China ETF really has been hit hard, well below the level that it was even 10 years ago. And you can see from 2021, it's really just been a progressive slide down. Just having a look at some of the bigger holdings in that ETF, you've got the likes of Guichao Motao, which is a massive brewer. Then you've got CATL, which is obviously an energy and a battery business. Then you've got a power utility, and then unfortunately quite a lot in the banking. We think Ping An is actually a good business, but you can see there BYD, which definitely has made massive progress. Also, I think position number 6 or 7. So yes, there's some banking exposure, but as you can see there, financials representing about a quarter of that index, but some very interesting businesses, and we remain confident that this ETF will do well on the long term. Then Prosus we acquired, when there was an aggressive sell-off a few years ago. It's become a reasonable holding in client portfolios. And it was really just, ideally, we would have probably wanted to buy Naspers, but obviously Naspers is an SA asset, whereas Prosus was the Amsterdam Exchange option. So it's done quite well if you look in euro terms. We still think there's quite a lot more to come, but again, we prefer Naspers, but are very happy with this offshore Prosus holding. Then a new holding across the board for clients is an agribusiness ETF. You can see it's come off quite significantly from where it was a while ago. You can see here it's really a bet on big agri. So effectively, we believe that agriculture is moving increasingly more sophisticated. It's becoming more technology driven, and unfortunately it favors the big. So if you look on the left there, some of those bigger holdings, the likes of Corteva and Archer Daniels and Nutrien and Deere, these are basically the companies that supply feed, agricultural commodities, equipment, irrigation equipment, as well as obviously some of them are growers themselves, the likes of Tyson as well. So very much US focused, over 50%. And there you can see consumer staples actually represents a fair whack, followed by materials and industrials. So this is really in part a bet on climate change impact on agriculture. But as we say, we think that the recent pullback offers good opportunities, and all of these companies actually have very solid fundamentals in their own right. So that it's not really a theme bet in its purest form. Then Richemont also used the weakness a few years ago to pick these up. If you look in Swiss franc terms, it's obviously like in rands, off its best level, but still from where we bought, it's done very, very nicely. And although I think the market is going to be anxious around the outlook for luxury goods companies, we think strong cash flow, strong cash underpin will support Richemont. So we do, however, expect a little bit more volatility on the short term. And if we find extreme weakness, we'll obviously possibly look to add to this position. Then Haleon has actually done very nicely since it was unbundled out of GSK. Obviously, the Zantac issue has been somewhat supportive, but it's a good portfolio. And again, in client portfolios, this was reflected as a zero cost, which is somewhat misleading. Brookfield Renewable Corporation, we've only held it for a relatively short time. It's come off from, I think, around 48 where we paid. So it's down quite significantly. We remain confident in the investment hypothesis and think that lower interest rates will actually help this. But really, just the whole business model about scale and being able to sell green electricity into the grid when corporates and governments have committed to cutting their emission footprint. So we think Brookfield Renewable will take a little while, but we remain very comfortable with the hypothesis. GE Aerospace obviously done very nicely after the abysmal GE story, but yeah, there's been quite a lot of value unlock, and it's good to see GE Aerospace finally showing some life. The Euro Stocks 50, it was really just a way of trying to play the euro market, particularly when Ukraine was invaded, and there was quite a lot of weakness, as you can see there in early 2022. It's generally worked out quite well, but it also gave us an opportunity to buy some of those Stocks 50 heavyweights, so the ASMLs and the L'Oreals and the LVMHs of the world, in a very elegant way. So we're very happy with the performance, and think there's probably a little bit more to come. Although, along with world markets, it just feels as though, on the short term at least, it's probably going to be a little bit vulnerable. So that's a very quick sort of 22-minute summary of the offshore portfolio performances. On balance of arguments, I think we're very happy with the likes of Micron and Microsoft and JP Morgan and Shell. Things like HSBC and Brookfield's may be more disappointing, but on average, I think global portfolios have done quite well, especially because we've been quite well positioned in slightly more defensive counters. We hope this has been of use and interest to you. If you have interest in our flexible fund, please watch the next video. We always welcome your feedback, whether it's positive or negative, on these videos, and we look forward to speaking to you soon.